TVB is the non-for-profit trade association representing America's local broadcast television industry. Its members include the U.S. television stations, television broadcast groups, advertising sales reps, syndicators, international broadcasters, and associate members. TVB actively promotes local media marketing solutions to the advertising community and works to develop advertising dollars for the medium's multiple platforms, including on-air, online, and mobile. Today we have Steve Lanzano, TVB's president and CEO, with us to discuss trends, opportunities, and challenges in local broadcast television. So Steve, if you wouldn't mind joining us on stage, we can get started with our fireside chat.
Good morning.
Good morning.
Wake up.
So I think you've been here quite a few years in a row now,
Yes.
So we really appreciate having you. For those less familiar with TVB, could you briefly discuss your background and all the work you've done at TVB over the last 15 plus years? And then talk to us about your decision to retire at the end of 2025. We'll be sad to miss you moving forward.
Well, TVB, we represent all the local broadcast stations across the United States, to advertisers, to agencies. We work with the NAB on subjects that are, familiar to both of us, like ad deduction, et cetera. I've been in the business 40 some odd years, and 30 of those years was on the agency side. So when I came over here, I was an agency person running one of the top agencies at Group M before I came to the TVB. I've been at the TVB for, this is my 16th year. So almost as many years as you have in this conference. I've been here probably just about as many years as you have in the conference, so thank you for having me. And I always say we have three legs to our stool. We have a business development team that goes out and works with the 5 holding companies on how we can get more national advertising back to local TV, and I know we're going to talk about that a little bit later. We work with local advertisers and stations, mostly with automotive. Obviously, still a big category for us. It might not be the 25% category, but it's certainly a 17 to 20% category. So it's very important that we retain that business. We do a lot down in Washington, D.C. Every acronym you name, we see. Every super PAC and PAC we see. And it's important that we, obviously, every other year, we retain our 50% share of not only total dollars, but almost 75% share of video dollars still to this day, even with streaming and connected TV. So that's one part of our stool. The second part is measurement. Obviously, measurement is very important, especially to advertisers. We have basically 2 measurement firms that do the local TV area, and that's Nielsen and ComScore. We would have liked ComScore to be a little bit farther along. It's difficult when you have one that has, basically 80–90% of the business, and it's hard to get them to move. But we have some initiatives moving forward. I think that'll help us in terms of being able to compete, especially with digital. I'll give you a quick example. It's quite astounding to me, but we're measured. You're not a viewer unless you watch 5 minutes on the quarter hour. Now, the funny part is the way they measure it, you can watch the last 4 minutes, like from, 9:56 a.m. to 10 o'clock, and then you could watch the next 4 minutes, okay, from 10:01 to 10:05, and you're not counted as a viewer. Meanwhile, if I'm a digital viewer, 2 seconds, half the screen, and you're counted. Now, how do you compare impressions, and how do you compare what's actually moving your business forward when the impression definition is different? So we went back to Nielsen, and I said, you know what, tell me why you came up with 5 minutes on the quarter hour. I don't understand it. Why aren't we average minute, like national? Why aren't we could be average 30 seconds? But how'd you come up with that? And this is a true story. No one can answer the question, right? No one at Nielsen can answer the question. And what we found, it was from 1927 when they did radio and did the average 5 minutes over the quarter hour for radio, because that's how long a song lasted. So that's how they were measuring us. So we've gone back to them to move to either 3 minutes on the quarter hour or 1 minute on the quarter hour. And what would that mean in terms of the impact on our business? Well, if even they went to 3 minutes on the quarter hour, we would increase our inventory by between 8 and 14%. If we go 1 minute on the quarter hour, you're talking 20 to 24%. And that allow us, again, to compete more with digital. So we do a lot on that. We do a lot of, and I know you know, Hannah, we do a lot of our own studies. We do a voter funnel study about what influences voters when they, are considering a candidate to actually voting for a candidate. We do a purchase funnel study on when people go through the purchase funnel on when are they get, how they learn about a product and actually purchase a product, and what influences them as they go through that journey. We do media comparison studies, one of our biggest studies. We do a lot. The other one is the Nielsen Gauge report, right? And I made a big to-do about the Nielsen Gauge report being the most irrelevant report for a marketer ever. Because what did they do? They basically looked at viewing for all streaming. Well, guess what? Not all streaming viewers can get a commercial. So if you're an advertiser, it doesn't help me if I can't run a commercial and reach you on streaming. So what we found was that their 40% streaming viewing number, when you look at ad viewing was actually 20%. And 80% was being, or between 50 and 60% was being done by linear TV. And those are the type of things we do. I always say we set the record straight, right? Perception versus reality, right? It's not cool that linear TV works, but streaming is out there, blah, blah, blah. But we have to set the record straight that it's still linear TV that moves your business forward. And then lastly, we do advocacy. We have, our two major conferences in a year. We have 5,000 people now that show up to our virtual sales conference, which we're excited about. And then we have an executive summit, which we do with about 200 people, very high level, lot more TED Talk type speeches that are being done across a variety of topics, from deregulation to what's going on with advertising to political and to automotive. So that's basically what we do.
Thanks. That's a very helpful overview. So starting big picture.
You didn't ask me why I'm retiring.
Oh, yeah. I did. You just didn't get to it yet.
I tried to avoid it,
Yeah.
but I won't. It's not with me, and people, why are you retiring? You're kind of not as young as, I tell everybody, I'm not as young as I look. Probably more on my top side will tell you how old I really am. But it wasn't an age thing. It wasn't a health thing. It was, I woke up, I told my wife, one day I'm going to wake up one morning and go, it's time. And that's exactly what happened about 6 months. I woke up, I go, it's time. And then I told our executive board, and they said, no, it's not time. And I go, well, it is time. So I'll actually be retiring at the end of the year. I'm just looking forward. Now, I said for a year to my wife that I don't want to be on a schedule, and she said a good 3 months, and you're going to be getting anxious again. She's probably right.
Yeah. So starting big picture.
Sure.
What are you seeing in terms of TV broadcast content and local news viewership trends? Who's watching? What are they watching specifically? And then you touched on a little bit how they're watching it, but that as well.
The world's become news and sports, right? Mm-hmm. Live event viewing. That's really what advertisers are looking for. I mean, one of the issues we have is a 10 p.m. Time period before our late local news, which is kind of a dead time period now. So our lead-ins are not as good, which is why our late local news has been suffering. Mm-hmm. But overall, people have a voracious appetite for news. I mean, from 4:30 in the morning to 10 in the morning to noon, in some cases noon to 2 to 3 p.m. broadcasts on a station, and it gets a pretty strong audience. In fact, if you were to look at the top shows in a market, you take out football, okay? If you look at top shows in a market, any market, our news is a top 5 show in every market, all right? You include streaming and everything. We're the top 5 show in every market. That's how powerful the news is. And the big question is, right, young people don't watch news, right? Well, if I was 17 and 18 years old or even 20 and I was sitting down and I told my dad I wanted to watch the local news, he thought I was crazy, right? It doesn't matter to me. But I get 25 years old and I get married and then I have kids and I buy a house, and guess what? The local news is really important. And in fact, during the pandemic, our news viewership went obviously through the roof. Against 18 to 24-year-olds, it went up 150%. Now, some people said, oh, God, that's great. But I'm going like, well, it's not going to stay that way, okay? When things normalize, it'll be. but we've been able to keep about a 4 or 5% increase from where we were prior to 2020. So that's strong. Now the big question is, what do we need to do in terms of local news to even continue to grow that? Because people watch it differently. They want little snippets. Some want longer news. I think one of the things that may come out of deregulation, and this is me talking more than anything else, one of the things coming out of deregulation is especially the ability to own 2 top 4 stations in a market. And then you have the ability to not only share content, but now you have the ability to test different content on different stations and what news works. Because a lot of them don't want to do it because it still gets a pretty good number. So why am I going to mess with success? But I think that might give opportunities for experimentation, especially against younger people. But what you see is the same curve I saw when I first started in this business so many years ago. As you get older, your local news, watching local news does this in terms of your viewership. And even though we can all get everything we want on this little device here, right? I can get the weather, I can get whatever I want. Anytime anything ever happens, our local news numbers go through the roof, whether there's a weather emergency or any type of emergency, they go through the roof. Why? Because people don't trust what they find, what they're seeing on here or what they're reading on here. What they trust is their local news meteorologists, their local news anchor, and their local news reporters. Mm-hmm. And that's the difference that we have versus everybody else. I always say, people want to, right? They want to replicate what we have, but they can't. They can't. And that's our big differentiation. So it really is a news and sports environment now.
Mm-hmm. That makes sense. You touched on potential deregulation and the ability to own 2 top 4 stations in a market could have a meaningful impact. Any other views on how the regulatory environment may shift in the near to medium term in light of the FCC and the dynamics there, and kind of what would be the biggest impactors there?
Well, 3 things is, obviously cars already show a proclivity to allow 2 top 4 stations in a market, which is terrific. And obviously the operational efficiencies would be enormous for the industry and for the local broadcaster. So that's 1. 2's the cap.
Yeah.
Obviously, cap makes no sense whatsoever anymore. Mm-hmm. I think the question is, and when a majority gets back on, now that Symington is leaving, now when the majority gets back on to the FCC, and I think President Trump we have 1 nomination, we'll have a 2nd nomination shortly, so they'll have the majority sooner rather than later. So the cap going away, obviously, is a big deal. The question is, can the FCC do it, or does Congress need to do it? I could argue it both ways. We believe the FCC can do it because they were the one that set the UHF discount. So they basically affected the cap already. So we believe they can do it. There are others that think that only Congress can do it because Congress was the one that set the cap initially. So I think that's still a little bit up in the air. I think that's probably at least a few months down the road. And then finally, sunsetting 1.0 to 3.0. I mean, that not only obviously the work that's being done by EdgeBeam in terms of data casting, and there have been some numbers thrown out there that could be worth $15 billion, which is what our retransmission consent is. So that's a sizable source of revenue. But for us, dynamic insertion, targeting, advanced targeting, attribution, data, I mean, that would be a home run for us. The question is how you get that install base up quickly. And the only way I see it going up is sunsetting ATSC 1.0.
Which is likely on the regulatory agenda moving forward.
Exactly.
Yeah, that would be great. And then you mentioned that you anticipate a 3rd Republican also being nominated shortly. I mean, timelines around that. We've heard a lot about Olivia Trusty. Very soon should be confirmed, but. And then any ideas on who might be up for that role? I don't know who
they're gonna. There are a couple names that are out there.
Okay.
I don't know them,
yeah.
So I don't want to comment on it. But I think Trustee will be quickly done. I think there'll be another nominated very quickly right after that.
Okay. Yeah. Great. So moving on to advertising, what have you seen in the core ads market over the last couple of months in light of all of the macro tariff dynamics and uncertainty? And then what are you seeing in terms of pacings and the outlook from where we sit today?
Sure. I mean, Hannah, you know, there's just so much uncertainty in the
Yeah.
marketplace, and for a marketer, it's very hard for you to spend money with uncertainty when your CFO is looking down your throat and going, "Why are we spending this money? We don't know what's going to happen tomorrow." The core marketplace, probably in first quarter, was down mid-single digits. A little bit worse than I thought it was going to be, and I think a lot of it was because of the tariffs.
Yeah.
And it scared people off. So the core market is probably pacing a little worse, but I think the question is what's the pacing moving forward? And it's very hard to get any type of vision looking forward because advertisers just don't know.
Yeah.
I think the local direct market is a little bit more stable. The national market, where it's based upon percent of revenue, right? It's very simple. Each category is almost, and even any marketer within a category, they're 3 to 5% in terms of what they put against advertising. So I think the question is, and we'll see what happens with the upfront market. I mean, the upfront market is going to be very interesting this year of how much money is put in, how much are they going to hold back for scatter, and the question is how much flexibility will the networks be willing to give?
Yeah.
The more flexibility you give, the more that you'll get up front. So I think it's going to be very interesting to see how that plays out, and nothing's happened in the upfront market so far, which is not unusual, but once you go past July 4th, then you know it's going to take a while. And I think it's going to take a while because I don't think anyone wants to put their foot in that water right now.
What's the typical split that you see between upfront selling versus leaving for the scatter market?
It varies, and it varies by year and what's going on. It's usually 75% is upfront, and the remainder is scatter because nobody wants to be caught with
Right.
paying more money and not getting the inventory they want.
Yeah.
Upfront market is based upon fear,
Yeah.
right? That's it. How do I scare advertisers knowing there's scarcity out there, it's going to cost you more, and especially agencies, and your clients are going to go berserk because they're not getting the shows they want and they're not getting at the CPM they're looking for. Now, some of the things that the agencies have done is principal buying, where they take basically the risk, right? You already set a base, so I'm going to meet your base, okay, and you're happy about that. Now, whatever I get above that base, I get to keep. And I think you're going to see more and more of that going on. Some of the agencies are doing it more, some are doing it less, but it is the way they're making money now because it's very difficult on the agency side of the business to find money.
Obviously, the tariff policies and those dynamics hit certain industries much harder than others. You mentioned auto. Can you touch on what's going on specifically within the auto market and then any other categories that are being impacted more significantly?
Sure. I mean, the auto market, obviously, you all know, people pull forward in terms of buying because they were fearful about pricing of cars going up because of the tariffs. And the industry had about 90 days worth of inventory back then. And as you got into, I'm going to say February and March, it went down to about 70 days. Why? Because people pull forward to buy cars. So they pull back, a lot of the dealers and the manufacturers pull back on incentives because people were rushing into the, if you had the cars, where people were rushing in to your dealership to purchase the cars. And in fact, first quarter was not bad. We did a little better with Tier 1, which is the manufacturer, right? The manufacturer doing advertising, buy Dodge or buy Stellantis or buy whatever it might be. And then it would be, then it's Tier 2, which is, your local Toyota automotive dealers. And then there's Tier 3, which is the local dealer direct advertising to the consumer. And actually, Tier 3 started to pick up recently because now there's about 55, 56 days worth of inventory. And some of that inventory is becoming tariff-priced inventory, if you will. So what do they have to do? They have to drive people to their dealership. Incentives are going to start to go up, and we should see some advertising from that, and it seems to be coming to fruition right now. So I don't want, in comparison to last year, we're doing okay. I wouldn't say that we're back where we were in 2019. Yeah. We're not even close. But it's not as bad as we thought it was going to be. I think moving forward, if tariffs stay in place, dealers, the one thing when I go see a dealer, I just saw one recently, it's a dealership in Cincinnati with 26 rooftops. And he told me, Steve, it's the price of the car. I mean, this is what's going to kill us. People just can't afford a car. The average monthly Everybody know what the average monthly cost is if whether you buy a car or whether you even lease a car? It's about $800. That's a lot of money. It's twice what I paid for my first apartment. It's a lot of money. So that's the big fear the dealers have. And then now the fear on the manufacturer's side is the magnets from the rare earth metals, which really, you can't build a hybrid or an EV without it. And in fact, even a internal combustion engine car, you can't build without it. Your windshield wipers won't work. Your steering will have a problem. So it's important that you have those. And that's their real fear, because some of those rare earth metals, 90% come from China. And right now they're restricting it in terms of allowing it for manufacturers, especially U.S. car manufacturers. So that's a real issue. Recently I was talking to Toyota, I was talking to Stellantis, and that's what they're really concerned about, is being to produce the cars. Not only on top of the tariff situation, but even be able to produce the cars, because they just won't have those rare earth metals, the magnets from the rare earth metals, to actually do that. And it could be a problem.
Mm-hmm. Any other categories that you highlight on either the positive or negative side in light of the current environment?
Sure. Lawyers, we love them. 10% of our revenue now. Great people, lawyers, by the way. Great people. It was a non-category when I started 16 years ago. It's our number 2 category now. It's just amazing. And why is that? Because people call those numbers, right? And I always say, lawyers, whether things are really bad or really good, guess what? You need a lawyer. So there you go. So it's just incredible how that is. I know your earlier panel talked about home improvement, and whether you buy a house or whether you stay in the house, you improve the home. Mm-hmm. So home improvement has still done well. Retail is kind of a little shaky. Department stores not where we like it to be. Farmers gotten better. We'll see what happens. I mean, there's been some thought by our friends in Washington about limiting farmer advertising. I don't think that's going to happen, quite frankly, but farmers gotten better. On the categories where, a little bit of a problem child, I mean, I wouldn't call sports betting a problem child. I mean, we make money now when a market opens up. Like the next market that'll open up be Missouri at the end of the year. But there are 3 big markets that we hope open up one of these days, and that's Florida, Texas, and California. And that would be big money. It's still a 3 or 4% category, right? It's not it was a godsend during the pandemic because it made up for auto advertising. And it's still going to continue to grow. And one of the things, is when sports betting first came out, it was betting who's going to win the game, et cetera. Now there are so many in-game betting that's being done, and that's one of the things the streaming service have problems with because of the latency factor of 70, 80 seconds, and right, you're not going to take a bet if it's 80 seconds after what happened. And I made some money on my kids on that, by the way, when they were watching downstairs on streaming, and I was watching upstairs on linear. So that's one area where we're seeing some money coming back, because if you want to bet in-game, you got to be watching it on the linear product. Mm-hmm. Otherwise, you're not going to get your bet in.
Yeah, that makes sense. Can you just touch a little bit more on why you don't think that there will be any changes to pharma advertising?
I think that the pharma lobby is pretty strong.
Yeah.
And they give a lot of money to politicians. So I think that'll be rethought. Yeah.
What would the process look like if it were to get banned? Who would be able to do that?
It would start obviously with Kennedy.
Yeah.
And his department, and they would bring it up, and then they would probably try to do it as an executive order if they were to do it. I don't think Trump will do it.
Yeah.
So I don't think it's going to happen. But that would be the start of it. It would come from them.
Mm-hmm. And then would it have to go through Congress or?
Not necessarily.
Okay.
Not necessarily. It's like cigarette advertising.
Yeah.
But that was banned. The industry banned themselves.
Right.
Right?
Yeah.
The alcohol industry banned themselves. And now look at all the alcohol advertising. In fact, 2 areas. Alcohol advertising is okay. Mm-hmm. Non-alcohol advertising, mocktails, is really the new hot category right now. It's not a lot of money, but it's a new hot category, and especially on a national level.
Mm-hmm. Any other hot categories or emerging areas that you think could become meaningful in the next couple of years?
Well, there's one thing that we're doing to try and bring back national advertising. With the agencies, especially the major 5 holding companies, The issue is not the efficacy of our medium, it's the efficiency of buying us. We are really expensive and difficult to buy. It's true. I mean, if you're an agency, you have to have 40, you want to do a 40 market buy, you have to have 20 people doing the buy. That costs them a fortune, right? What are the agencies? When you look at their cost structure, right, agencies are people, real estate, and now data. Well, they're not getting rid of data because that's their differentiator, and that's how they're able to compete with the other agencies in the market, okay? Real estate, they're trying to get, they're getting rid of as much real estate as possible. One agency has asked people to come back full-time. I think that's going to be a complete disaster. Most of them are saying you can work remotely, maybe hybrid 2 or 3 days a week, and they've learned how to do that. So the question is people, and how do we save money? And what we are doing is, again, national advertisers want our inventory, but they can't get access to it because it's just too difficult, and agencies just push back. Right? It's very easy to buy digital. It's about hands-on keys, right? I have a 25-year-old with their ear pods on a long desk, right? And what they're doing is doing this. And if you're not on their screen, they ain't buying you. All right? We're not on their screen. So we are actually, I announced it last week, we're actually building a self-serve platform with the backing of all of our members, with the backing of all of the agencies. We're actually going to our executive board as we speak, as soon as I get out of here, to actually do a recommendation from the RFPs. And we got really strong responses on the RFPs to build that platform. And it's not about building. We should have built the platform 6 years ago, right? It was, well, things are good. Why are we doing this? Well, we should have built it 6 years ago. We're building it now. And the timeline's pretty quick. I mean, we want to be in testing in the fall and having it a go by January 1st. But what I got back from all of the chief investment officers at the major holding companies was, if you build it, we will come. And if you make us as easy to buy, if you make you as easy to buy as digital, we will buy your inventory. So we hope that will start bringing back CPG, where we get 2 to 3% of the dollar. I mean, that's nothing, right? If we got 3 to 6% of the dollars, that's pretty significant. Yeah. So the interest is there. Now we've got to give them the ability to buy us as efficiently as possible, because I can't put my fingers together as close as I can in terms of what agency profit margins are.
Yeah, that's helpful. Any questions from the audience? I have a few more as well. There's one right here.
Hey, so great presentation. I was just wondering if you could touch on programmatic and how, I know you talked about local versus national, and maybe is programmatic kind of changing the dynamics between how local interacts with national? And then on a separate note, the sports betting, I don't do it, but I have a lot of friends that do. And do you think TV still really has that latency advantage when it comes, to sports betting?
One, I'll take your last question first. One is absolutely. I see it every day. I mean, in fact, when I speak to my son, like Mario, I'm watching the Yankee game, and I'm speaking to my son, and I'm screaming at the screen, and he's going, "What are you screaming about?" So the latency is there, and I don't see it changing overnight. It's just not enough, there's just not enough spectrum out there to make the latency go away, quite frankly. So I think that's going to stay that way. Regarding local and national, I think it's really more on, you did hit on something, and the national marketplace is, as I said, hands-on keys and buying it that way. And in fact, one of these days, it'll be not only hands-on keys, it'll be an AI that's going to be planning and buying inventory. It's just a fact from the agency side. That's actually going to happen. So we need to get in that game, and that's why we're building this self-serve platform in terms of programmatic. We are hearing from some local direct advertisers saying, this was actually a big regional grocery chain saying to me, "Steve, I can go on my computer, have somebody who works for me go on the computer, I can buy all this connected TV inventory, and you're not there." And that's why you're seeing us move more and more on it, because I don't need an agency. I don't need 50 people. I need one person that's going to buy it. So that scared me more than anything because 75% of our business is local direct and 25% is national on average. Obviously, when you get to smaller markets, it's probably 90%, right, local direct and 10% national. So that scared me more than anything else because if that starts going that way and if we're not in the game, it would be problematic. I hope that answered your question.
Any other audience questions, or here's another one.
Everyone here, thank you for joining us today. I had one on just easing the friction on ad buying. How long do you think it'll take to build a new platform, and what do you think that looks like in reality once it's created? Is it some aggregated platform all the companies are using, or each company will have their own platform in-house?
Great question. We obviously are pushing that it's one, and what we got through our membership is it's one aggregated platform, right? Because you don't want somebody, I call it the swivel chair. I got to buy Sinclair here. I got to buy Nexstar over here. I'm buying one market, and I'm trying to do it across 4 different screens. That makes us even worse in terms of trying to buy us. So it really has to be one aggregated platform. That's not to say that one of our broadcast partners may decide that they want their own platform. But to me, if we're going to make this work, it has to be one aggregated platform. And as I said, the timing is we want to be in testing, and we've got 5 holding companies as well as a company that we are recommending to build the platform, ready to go probably mid-September to test it. We're going to test it across about 15 markets, and then across all markets be ready to go by January 1st. It will not include political. Political with LUR and all that goes on there. Didn't want to get into that yet. And it will only be linear inventory right now. Then we're going to plan on adding connected TV, social video, streaming, whatever you might have. So you'll put all of your video on the platform ultimately.
Great. Well, thank you so much. I think we're about at time. Obviously, could go on for hours with everything going on, but we really appreciate you being here, and we'll miss you moving forward.
Thank you.
Thanks
Thanks,
so
Anna.
much.
It's been my pleasure. Thank you.
Chris Morangi is a co-CIO, and Sergey Blazewski, Hannah Howard, and Justin McAuliffe are portfolio managers Gabelli Funds. This podcast is an excerpt from Gabelli Fund's 17th Annual Media and Entertainment Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of March 31st, 2025, affiliates of GAMCO Investors Incorporated beneficially own on behalf of their investment advisory clients or otherwise approximately 31.43% of Atlanta Braves Class A, 6.32% of Class C, 11.32% of Sinclair, 5.41% of EW Scripps, 2.67% of Gray Media Class A and less than 1% of Common, 2.41% of Tegna, 2.25% of Ryman Hospitality, and less than 1% of all other companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI 800-422-355-4914, 921-5100 fax, 914-921-5118 info@gabelli.com.